Welcome to Module 15, where we're going to discuss payments. Payments flow somewhat from our last two modules, which were electronic banking and fintechs. Payments traditionally involved a physical card or a check, but over time, as we see, and what's increased after the pandemic, many of the payments, although there may be a physical card or there could be a physical check option, are done electronically. The three main types of payments that we see today are the debit card, the credit card, and the ACH. Starting here at the bottom, the ACH are the automated clearinghouse transactions. And those are the transactions that come directly from a deposit account, which must involve a bank, as we know, to whoever is going to be the recipient. And these are governed in part by the NACHA rules, the National Automated Clearinghouse Association. So this is an interesting area where we have laws that govern deposit accounts, but we also have an association that governs how these transactions flow, and the rules are extremely detailed regarding what you have to do, and they are also supplemented by the law. Then we have the credit cards, which several of our cases dealt with. And you see in these cases from the 80s, they're really explaining a credit card because they really only started in the 70s. And even in the 80s, there wasn't widespread knowledge or understanding of what credit cards were or how they operated. Originally, there was Visa and MasterCard. We now know there's American Express and Discover. But the thing to keep in mind is that it must always be a bank that issues the credit card. And there are, again, rules that govern the credit cards through Visa and MasterCard, the association rules, as well as laws and regulations. So again, we have this mix of association rules and laws. And then the most recent addition, or maybe about the same time as the ACH, is the debit card. Debit cards are typically associated also with a deposit account. And even if they're preloaded, as we will talk about, typically there is technically at least a notational deposit account. And they can be either online, which is more common in Europe, where you use the PIN, or offline, where you use the signature. But through the development of these payment systems that, as I said, go through really just a handful of organizations, we have seen antitrust challenges. And so that was our first case that we read for this module on 278, where the group that was processing some of these payments, and again, we see this is in the 80s, filed an antitrust suit regarding the interchange fee. And so the case really talks about both how the system works as well as what the interchange fee is. And just to let you know, that dispute is continuing today, and there have been many lawsuits about it, as well as laws that have made its way through Congress. So basically, the interchange fee is the payment that, in this case, in the suit, it was Visa was requiring to access the system. And in the 80s, the fee was pretty much set. We now have a much more nuanced payment system, or the fee varies based on the type of transaction. But back in the 80s, it was pretty much just a percentage. And so the merchants and their association felt that this was price fixing because they couldn't really do anything about this, because at the time, Visa was about the only player. And so they said it was anti-competitive. There was also the issue that the only other player at the time was MasterCard, and they tended to do exactly the same thing. But I think for our purposes, it's important to understand how the transaction works. And so I do have this diagram. And so when you look at this, on the left, it says the acquirer, and it could say the acquiring bank, because the acquirer must be a bank. On the other side, we see the issuing bank, obviously a bank. So the issuing bank is the bank that issues the credit card. In this case, it's to a consumer. And so the bank is giving a consumer a credit card with a credit limit, which the consumer can use to purchase goods from the merchant. Now, to accept a credit card, the merchant must have a relationship with an acquiring bank. And there are going to be agreements, both between the bank that provides a credit card to a consumer and an acquirer who allows a merchant to accept credit cards. And then we see up here at the top is the network, could be Visa or MasterCard. We'll say it's Visa. And so what will happen is the consumer will pay for something with a credit card. The merchant will then send that payment or that kind of receipt, whatever you want to call it, up to its acquirer. The acquirer will send it through the network to the issuing bank. The issuing bank will send the money to the acquiring bank, although it will hold back its interchange fee. And the acquirer will send that money back down to the merchant, but it will also hold on to a transaction or a merchant discount fee. And then the issuing bank will send the consumer a bill whenever it is time for a bill, and the consumer will then have 30 days to pay that bill. And so in the footnote to the next case, I believe it's on page 282, there's a little bit of an example of how this could work at the time. So it says if the consumer had bought something for $100, the merchant would get $98.40. So they have lost $1.60 for the convenience of accepting a credit card. And of that $1.60, it would be typical for the issuing bank to get $1.25 and the acquirer to keep 35 cents. And the acquirer is really just very much a processor, a go-between. But the issuing bank has extended credit to the consumer and must then collect from the consumer. And the merchant, although they've had to give up $1.60, is also going to get that money in a very short period of time and is not going to have to deal with the consumer. And in fact, as we read in one of our cases, at the time, it wasn't uncommon for a merchant to, with regular customers, just write down what they owe. They were doing this on an informal basis. But in that event, the merchant would have to occasionally ask the consumer to pay up, and the consumer may or may not. So although the merchant is out $1.60, clearly as a business decision, typically the merchants accept credit cards because it drives sales and they actually can get their money faster and more securely than even accepting a check or other methods. The case talks about the four kind of the entities involved, the cardholder, the merchant, the financial institution that issues the card, and the financial institution that has the relationship with the merchant. And it would be possible for the same bank to issue the credit card that has the relationship with the merchant, but that would just be, happenstance. It's not required. So essentially, it's a four-party transaction with Visa, MasterCard, whoever is the network in the center. And as the case talks about, and I just mentioned, what we really saw was originally there were checks and other kinds of bank notes, but retailers then actually started opening accounts. And it would be an account that you could just use at their store. It could be a formal account, or it could be an account that was basically just little notes taken to the cash register. And so eventually, from what people were doing kind of on their own, the bank credit card system was created. And it really does benefit everyone. But the question is just, are the fees reasonable, and is there too much power? Because there are, and have always been, a limited number of entities. And so in 1984, the court did find that Visa lacked the market power to restrain trade. Because really at that time, it was a very small percentage of people that even had a credit card. Our next case was brought in 2001 and goes into 2002. And so the question is, had the system changed by then enough that there could be a successful antitrust case? And there continue to be antitrust challenges today. And so the question is, has the situation changed more but maybe in a way where there are more different players and more different payment methods. So if anything, I would say sort of the height of Visa and MasterCard's power was probably around 2002. And now that we get further into the 2020s, there are more options. So the key to remember, though, is that it's not just the interchange fee that the bank has to comply with, that Visa and MasterCard rules, interestingly, they tend to be very similar. They're now public. One is, I don't know, 350 pages, and the other one is 850 pages. But if you look at any particular topic, they don't vary that much. They're just written differently. We continued, though, our reading in additional antitrust litigation. And the next case that we looked at was actually bought by the retailers themselves. And it was some very large retailers. We see Walmart, joined by many small retailers and their trade associations. And this challenge was to some of the other rules that I referred to. And one of them was the honor all cards policy. Because by this point, we're starting to see some more debit cards. And one of the things to keep in mind is that completely and totally different rules and laws apply to debit cards and credit cards. Although from the consumer standpoint, it may seem very, very similar, if not the same. Legally, they're completely different, but also the risk is completely different. A credit card is an extension of credit. Someone buys something and in the future is asked to pay for it. A debit card is going to come out of a deposit account in anywhere from the day the transaction occurs to probably 7 days at the outset. And so in this case, the challenge really was that, first of all, they said the fact that there are two of them, that doesn't help the antitrust situation because the rules are almost identical, and I would have to say that's fairly true. And also that they allow a merchant to accept each other's cards, but at the time they didn't allow a merchant to accept anyone else's cards. And once you accepted a card, you had to accept every card with a Visa or a MasterCard logo. And one of the things to know is that the fees on different types of cards vary. Even whether you have a silver card or a platinum card, the fees will vary, and whether you have a debit card or a credit card. And so the merchants made the argument that maybe they didn't want to accept all these cards, but because Visa and MasterCard had this same rule, they made them honor all the cards, which they would not do otherwise. Now, we'll come back to that to see if that is really true. And if you think about it, would they really say, hey, you have a silver Visa, we're not accepting that, but you have a basic Discover, we're going to take that? I question that. But getting back to the case, it really focuses on the fact that the two types of debit cards had essentially the same fee. And one, which is the online, where it's verifying the funds and really talking to the bank immediately, had essentially the same fee as the offline, which is really somewhere between the online and a credit card in that the funds are not verified and it can take up to 7 days. So they said, really, maybe we only want to accept the online, and we think the fee should be different because you're not taking the risk. Visa and MasterCard obviously disputed this and said that the fees did take into account the risk, and that the fees were rational and, of course, not an example of antitrust violation or price fixing. The other part of the allegation did go to the fact that they require you to accept all of the cards once you accept one. And so you're really sort of the price fixing as well as the monopoly. And what happened in this case was that the court allowed the class certification because obviously everybody who has a card, very similar. And so once the class was certified, in this case, Visa and MasterCard decided to settle. That's not particularly unusual once we get a class certification. And so the settlement of this case really has significant ramifications. And part of that is because they abolished the honor all cards rule. And that is sort of the point I wanted to bring up, is that Walmart actually stopped accepting a certain type of credit card that had, or debit card rather, that had a very high fee. But as you can imagine, if you're accepting all debit cards except maybe one that said, you know, MasterCard money back, consumers are not really aware of that. So it was really just sort of a protest that went on for about a week. But what was really more important than abolishing the honor all cards rule, which honestly is very difficult for a retailer to pick and choose, is they did lower the fees and they started to develop this very complex system. The interchange fee is now available online. It's somewhere in the neighborhood of 12 to 15 pages. So if you're automobile dealership, you pay one set of fees, and if you're a grocery store, you pay a different set. If you're a coffee shop, and so they did respond by making the fees much more sensitive to the transaction and to the risk. So this really has at least addressed some of the complaints. They also allowed the merchants to offer other types of cards. So prior to this case that's referenced in your notes, they did not allow someone who offered Visa and MasterCard to offer Discover or American Express, except under certain limited situations. But as part of the settlement of some of these cases, they have now allowed that. And, you know, there was a time when many places did not accept Discover, but now we see most do, and American Express maybe less so, but that's largely because the fee structure of American Express is the highest. Because of all of this, Dodd-Frank Act did require that there be a rule that would bring down the per transaction fee, because the fee, these interchange fees, are typically sort of a set fee plus a percentage of the transaction. And prior to the Durbin Amendment, which is what the amendment to the Dodd-Frank Act that dealt with the interchange fee is called, most retailers were charged 44 cents per transaction. And after the amendment, that 44-cent fee was capped at 12. The original proposal was to cap it at 7, but through negotiations, it went up to 12, and that was what was adopted. There are still discussions about moving it down, but it's not completely clear if that's really going to happen. But this does kind of just bring up this whole issue of compliance. Obviously, that's our focus. I did just want to give you kind of some background on these payment cards and some of the cases that got us to where we are now. But a compliance issue relates to the use of some of these cards in new situations, such as payroll cards or for insurance purposes, because we then have, in addition to the banking laws and the credit laws and even the association rules, you can have insurance rules or employment rules. And so as a compliance professional, just because someone is getting paid on a payroll card doesn't mean typical employment rules don't apply, which prohibits charging someone a fee typically to pay them. And the other issue that comes up with these types of prepaid and debit cards that are being used more often as payroll cards and insurance benefit cards is whether or not they are deposits. And this is a very important compliance question, because if there are deposits, they're subject to FDIC insurance. They have to be reported. It impacts whether a cardholder has any rights. If you drop your debit card, is it like dropping a $20 bill? Or is it like losing a check. And whether it's a deposit will also impact a bank's reserves and assessments. And so the FDIC really went back and forth on this issue for quite some time, but ultimately it has been determined that if the funds are deposited in a bank, which as I mentioned at the beginning of the module, they typically are, and if records are maintained of account holders, they are treated as deposits. And banks are encouraged to always do everything they can to treat them as deposits because they are more often used by low and moderate income individuals. I mean, everybody may use them, but low and moderate income people may use them almost exclusively. And so by treating them as deposits, those individuals can get more of the benefits of the banking system. But as I said, in this area of payments, you really have to look outside just the typical laws and regulations. You have to look at the NACHA rules, which they are available online, but you do have to pay a fee to get access to them, as well as the card association rules. As I mentioned, Visa and MasterCard rules are now available online. When I first started practicing, they were not, and I had access to them, but they have big confidential stickers on them. So we've come a long way. Discover rules and American Express rules are not as readily available online, but it is a compliance area that is not quite as typical because it does bring up the fact that there are not only laws that you have to comply with, there can be association rules that for all intents and purposes are as important as laws to comply with. So if you have any questions on any of these materials, please just reach out to me or shoot me an email. Thank you.